Welcome investaholics and friends to another ETF Spotlight review. Today we'll be taking a look at CETF, which is the VanEck Vectors FTSE China A50 ETF. So investing in one of the world's largest and fastest growing economies could be a great strategy to build your future wealth. The Chinese economy is set to overtake the US economy in the coming years as the largest economy globally. China is also expanding its global reach and influence. These factors should be a big plus for Chinese companies over the long term. If it does pay to remember that China is not a free market like Western nations, with heavy government control and a lack of transparency, and there's definitely differences between Western and Chinese business cultures as well. I think those are some risks that you need to take into account when you're considering China as an investment. But hang around, we can go through some of those problems as we go through the rest of the presentation. Well, hello there, investaholics. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. My mission is to give you the knowledge and confidence to take control of your own personal finances, expand your investment horizons, and crack your financial sky. Investment objective. CETF gives investors exposure to a diversified portfolio comprising of the 50 largest companies in mainland Chinese market. CETF aims to provide investment returns before fees and other costs, which tracks the performance of the index. The FTSE China A50 index is a market capitalization weighted index designed to represent the performance of the 50 largest companies by full market cap in the mainland Chinese market. Why would we bother with this one? 100% China A shares exposure, access to a diversified portfolio of 50 of the largest companies in the mainland Chinese market, as we said. A shares growth driven by domestic consumption. Domestic consumption growth in China is the highest in the world. Broad and competitive index, so the FTSE China A50 index is comprised of large companies, many considered to be pillar companies of the Chinese economy, who are leaders in their industry. So definitely some large and influential companies included in the index. Let's have a look at some of the numbers. We had a net asset value of $56.76, trading just below that, apologies there, that $56.48. Market cap of $19.5 million, management costs 0.6%. You have a dividend paid annually in January. Dividend yield is pretty low at 1.37%. So this ETF gives investors exposure to the Chinese economy through an investment in the 50 largest companies in the country. China is speeding headlong into a transition to domestic consumption, which is driven by a fast-growing GDP per capita and progressive domestic policies. The Chinese economy is set to become the largest in the world over the next few years. Therefore, it's where most of the growing companies will come from. However, China is not without its risks, so caution is advised. Previously, CETF tracked the MSCI 300 index in the fund issued and operated by VanEck in the States. However, recently VanEck in Australia determined that CETF should maintain a broad exposure to the Chinese market. To do that, CETF ceased investing in the United States fund and instead invest directly into a portfolio of China A shares. The index that CETF tracked was changed from the MSCI 300 index to the FTSE China A50 index. Obviously, there was no major charges associated with that for investors at the time. So that happened on the 23rd of April, I think, from memory. If you're looking at some alternatives, definitely have a look at IZZ and China New. We'll have a short presentation on China New in the next day or so. That one's an interesting option as well. So have a look at some of the holdings. A lot of these companies I've never heard of. Obviously, they're mainland Chinese companies. So maybe it's worth having a look at some of these companies before you invested in the ETF. Looks like utilities and banking is a major constituents here. The graph on the right hand side of the performance of your growth of your hypothetical $10,000 investment doesn't look overly exciting. As I mentioned, effective on the 23rd of April 2020, the fund changed its investment strategy from tracking the MSCI 300 index to tracking the FTSE China A50 index, if I can get my words out right. So when you're looking at the graph, the performance data from the 23rd of April 2020 reflects the current investment strategy, and data prior to the 23rd of April reflects the performance of the previous strategy. So that graph can be a little bit misleading. So total return since inception per annum is roughly 5.3%. Not overly mind-blowing, but I suppose it's solid at the end of the day. Would I invest in this one? Probably not. If you're going to invest in China and take the risk, you might want to look at something with a little bit higher rate of return, but I suppose that's definitely specific to your investment goals. Definitely one to have a look at, because I think a lot of the growth in the next 10, 20, 30 years is going to come out of China and possibly India as well. So definitely some food for thought. And if you're looking at some emerging markets exposure, definitely China and India aren't a bad option. But as I said, I think there's better options for exposure to China. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's CrackTheSky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.